Good afternoon, and welcome to this quarter's review of Manufacturing Outlook. My name is Richard Austin. I'm the partner at BDO, and I'm head of manufacturing for the UK. Thank you very much for joining. So you will have seen in the press that we launched our most recent quarterly report yesterday. Hopefully you've had a chance to have a look through that, but if you haven't, please do. But this webinar will basically build on that conversation as we go through. It's fair to say, and James will pick up on this in a minute, that it's a mixed picture when you look at what's come out this quarter versus the last couple of quarters of this calendar year. Confidence is definitely up, but some of the other metrics that we look at are either flat or slightly down. So it'll be interesting to explore what's behind that, what hypotheses we might have, and the sort of questions we might want to ask around that. So helping with that part of the session will be James Brougham, who's on camera with us right now. He's our senior economist at Make UK, and he'll take us through some of the main statistics that have come out of the quarterly report. And as we go through, please do put any questions into the functionality on the webinar as well. We'll pick those questions up at the end of the session. Following that, we're delighted to have Stephen Phipson join us for a conversation around all things manufacturing. So Stephen's Chief Exec of Make UK. Effectively, we'll be sort of looking at where the opportunities lie for manufacturing, potentially where the challenges are as well, and obviously being quite close to government is quite an interesting place to be at the moment. So it'll be really helpful to get some insights from Stephen in terms of expectations of the new government, what we can expect to see, and what manufacturers are hoping to see from government as well. So we'll look forward to that as well. And then following that, as I said, we'll take some Q&As at the end of the session. The other thing to point out is our most recent quarterly report also includes a spotlight on supply chains specifically. So we've been asking quite a few questions around what supply chains are looking like, what expectations are, what are the major trends, etc., and what potential disruptions that companies and manufacturers are looking at around manufacturing in particular. So please do look at that as well. It's a really good read, and we'll probably touch on some of those points during the conversation this afternoon. And as I said, at the end of that, we'll be picking up around any Q&A. So please do put any questions in at the end of the session. With that, James, I'll hand over to you to give us a quick run through of all things latest quarter. Over to you, James.
Thank you, Richard, and good afternoon, everyone. I suppose I should start off by saying those of you that perhaps joined us last time or are familiar with the second quarter's work of this year might remember us talking about our confidence sort of as analysts, not necessarily the sector's confidence, in being able to post that we'd likely see positive growth in our core metrics of output and orders this quarter. And I think Richard alluded to that at the start, that actually a mixed picture has emerged where the core performance metrics, talking about output and orders, haven't quite come in where we as the pundits would have expected them to come in. But nevertheless, the sector's business confidence and other future-looking metrics about measuring the future sentiment of the sector do remain markedly positive. So it creates quite an interesting picture. But nevertheless, in the short term, we haven't really been able to look beyond that. And so we have had to reduce our forecast for manufacturing GVA this quarter, which means that the gap between UK GDP forecast and manufacturing GVA has widened a little bit. But that's really in this year, in 2024. And of course, as we move towards the end of the year, that forecast becomes more tight and more accurate as we get a clearer picture. But 2025 remains unchanged and a little uncertain, to be frank, but uncertainty within quite a low area and not much hopes for a significant explosion of output in next year. So if I can have the next slide, please. So as I mentioned, output has turned negative and just negative, and we'll see that, and I'll clarify when we interrogate some of the points bit by bit, but this is just the overview here. And output has turned negative, but only marginally so. But it's quite important because we were quite confident that we would see steady, albeit slow, growth in these metrics in this quarter. We still hold out hope for next quarter because it seems at the minute evidence pointing towards a short-term flash in the pan because it's backed by pretty unwavering confidence and business confidence in those future expectations in the sector. One thing to pick out with on orders, if we're looking at that second bullet point, is actually we've seen export in the short term in this past quarter, export order balance figures grow in relation to those domestic orders, and we actually saw a little bit of that last quarter as well. I think one of the most important sideshows of our work in the past year has been keeping a close eye on that price setting behavior within the UK's manufacturing sector, particularly relevant, of course, now because we've just had the bank lower the rate for the first time in almost what feels like living memory. And that's going to provide a strong signal to the sector about how it goes forwards with its price behavior. We did see a little bit of supply side inflation creeping in just the quarter before last, but that did ease quite quickly, and we'll see that when we get to that slide as well. To back the point around output and orders coming to a bit of an unexpected hiatus in terms of their growth this quarter, we see too being backed by employment. On aggregate, employment activity has pretty much turned flat. Technically turned negative, but we'll see on the balance figure is pretty much flat. And so this is really tantamount to a short-term hiring freeze. And I say short-term because it's particularly short-term because I'm only talking about the intervening period, of course, between the second quarter of this year and the third quarter. And so it's still that can coexist, and it's not mutually exclusive from the fact that there still is an above normal level of vacancies in the sector, although that is coming down, and I'll make mention on that as well. Investment activity does remain sort of in its holding pattern, a positive level, but it really unchanged for about 2 years now. Of course, I gave hint that the Bank of England's base rate decision will likely start the domino effect over the last year of seeing some of that capital expenditure that's been parked on the side start to be unlocked. We've seen over the past 2 years that actually, despite some very successful in terms of well-received pro-business investment policy from the government in that time, hasn't really managed to move the needle on aggregate in terms of those investment intentions over the past year or 2 years. One of the big things that Richard mentioned there is that business confidence remains completely unfussed by these short-term metrics. As you'll see when we get there, it's a growing, it's a strong line, it's very robust. And so perhaps it adds a little bit of calm to us when we look at these quarterly figures and we perhaps get too worried looking at the short-term data, that the sector is reported by its confidence does not seem to be particularly worried by this individual quarter of data coming in a little beneath what we had hoped, and no doubt the sector had hoped as well. As a result, though, in the short term, I mentioned that our manufacturing GVA forecast has been reduced. It had previously been at about 0.8 in the first quarter. In the second quarter, it had grown to 1.2. This is for 2024, had grown to 1.2, and now down to 0.5%. So depending if you're a relativist or not, you could say, gosh, the forecast has halved or doubled, in the course of the past couple of quarters. But we are splitting hairs here because we're talking about 0.5%, 1%, 0.8%. These are still quite diminutive figures, and certainly no expectations for a significant contraction, but on the other hand as well, no significant expansion. I think more important than the variability in 2024's forecast is 2025 forecast, which has remained unchanged. We've had little to move us to change that forecast, and perhaps rather unexcitedly for the sector, a 0.8% forecast for 2025 is fairly pedestrian at the moment. I do think, though, as the time of presentation, at the time of publication on Monday, as of the time of the last forecasting round, 2025's forecast has more upside in it than not. And so what I mean by that is that it's more than likely to be revised upwards. Particularly seeing as we've seen the downgrade in 2024 this quarter as we move towards the end of the year. So I still hold breath that we'll see a full percentage point at least, which still isn't huge, by the fourth quarter next year. So let's have a look at some of these metrics bit by bit. If I could have the next slide, please. Now we're looking at here output and orders, and I will always give the health warning, and those of you that have seen this data before will likely be familiar with it, but those of you who are not, where you see these bars, they do not represent an absolute change in output or orders or whatever the given metric might be. What they represent is the balance of industry. So there's the proportion of industry that represents an increase in output or orders or whatever the concern might be this quarter relative to those that do not. So if we draw our attention to the far right-hand side, as I'll often be asking you to do, you'll see here actually in Q1 and Q2, 24 Q1 and Q2, so that's the penultimate two groupings of bars, you'll see we had orders and output, and orders just slightly leapfrogging output. This tends to be the healthy signal that there's a good demand pent up, even though the overall levels aren't very high, but for subsequent growth in the next quarter as those orders filter through the system. Now we saw the same again in 24 Q2, but the overall scale was increased. This is what, in the main, led us to conclude, in our view, that we're quite likely to see in 24 Q3, void of any serious economic shock to the UK or any serious disruption, which I think it's probably fair to argue there has not been between Q2 and Q3. We'd expect to see that staircase slowly continue to grow with orders exceeding output, because we know generally demand levels have been strong in those previous two quarters and growing. We see that hasn't been the case here. We actually see output in the far right grouping of bars has come in beneath the zero line, so indicating a slight contraction on aggregate in terms of that balance figure. And demand remains positive, but suppressed compared to its previous level. When we talk about employment as well, this is all pointing towards this data a short term. We say short term because we don't have a view into the longer term about continued suppression. We don't think that is there in the sector at the minute, but this certainly points towards a short-term suppression in the intervening period between Q2 and Q3 in manufacturing activity that we didn't expect and the sector didn't expect. However, the scale of negativity is very, very marginal, so it's nothing to get too worried about in terms of a recessionary movement in the sector. We can have the next slide, please. We'll look now at orders. So it's the breakdown of that orders bar. And I mentioned at the start, we see if we look just to the left of that green box bar, and I'll explain what that is in a moment, we can see the red bar just beneath the zero line and the orange bar representing export orders and domestic orders, formerly, respectively. And we see that actually export orders, like we saw last quarter as well on balance, the sector reporting is performing better quarter on quarter than domestic orders. But looking at this green box bar, and this is a phenomenon we'll see carry on throughout a lot of the data, what this green box bar represents is the sector's view on aggregate of how those metrics will come in this case, UK orders and export orders on balance next quarter. So you can see it's very positive, and that's not our forecast. That's not something that we fiddle with. That is just asking on aggregate the sector, the next 3 months, where do you expect to post those figures? And so you can see it's remarkably confident with regards to where those orders are going to be. But what's particularly interesting is that we'd seen a very similar effect last quarter. And those of you that remember last quarter might remember me talking about the exact same thing, where the sector has predicted for Q3 a significant expansion in orders where that didn't actually come to pass. And that actually the same thing happened in Q1. And this year has been characterized so far, Q1, Q2, and Q3, and likely Q4, if this trend continues, has been characterized by this degree of overconfidence, not with regard to business confidence as a separate metric, but with regards to the sector anticipating on any given metric, orders, output, and to a certain degree, perhaps prices and employment and margins as well. So you have the next slide, please. And we marry these up. So you can see here, this is effectively detailing or showing, illustrating that relationship between the sector's future expectation and what had actually come to pass. So it's a little bit confused, but I'll walk you through it. Again, if we just draw our attention to the far right-hand side, you'll see the bars represent where the sector had expected the balance figures for output and orders to come in when they set those expectations in the second quarter of the year. We're now at the third. And the dots is the latest data published on Monday of where that data has actually come in when we look back at it. So you can see perhaps the most egregious overestimation occurred just now, just on Monday, where we see those bars well ahead above where those dots have come in. But we saw the same effect, perhaps to a lesser extent, in Q2 and Q1 as well, if we look back to those penultimate two bars from the right-hand side, where the expectation is higher than what's actually come in. And indeed, perhaps it's grown consistently, that gap between expectation and reality, for lack of a better word, in that time, which leads us to think that we'll likely see similar in the next quarter. So the question that you might want to ask me, and understandably, is, well, what does this mean? And surely the sector aren't so oblivious to what's going on that they're overposting quarter on quarter. What we think is this represents the confidence metric that we'll see. And also what it also represents is the relative stability in the business environment in the past year compared to the previous 4 years. And it's something that we really like to focus on, I think. And it's a really important point that actually when we consider the manufacturing trading environment throughout 2024, I think it's probably fair to say in the main that the sector has had the most stable business environment relative to any of the 4 years preceding it, because of course COVID immediately, energy crisis, inflation crisis, so on and so forth. And then subsequently as well, serious employment struggles with regards to vacancy rates in the sector clamoring for labor, which has led to a very inconsistent environment over the past 4 years that's been characterized by disruption in one way or another. Can we have the next slide, please? Now, prices, something that I think is particularly interesting, I like to focus on as a sort of pet project. But we see here, and those of you who have been here before will be familiar with this rather mountainous price setting behaviors chart. We can see it is starting to cool consistently. So if we look at as per usual, the far right-hand side, we can see that UK prices and export prices represented on balance by the red and orange bars, respectively. We can see those are consistently stepping down, still in growth. So as well, important not to misconstrue this as them being sort of prices coming down, but the rate that the proportion of the sector suggests that they're increasing their prices is coming down. I mentioned that blip, and you can see there at about 23 Q4, you can see that that bar about 4 groupings of bars back from the far right. You see it grew again. So I think this put us on notice a little bit, because we'd heard, and through other metrics as well, that supply side inflation was eking back into the system in the short term. Then of course this was just before well, they took recess, but just before prior to the bank's most recent decision. And we held concern that if supply side inflation continued, particularly in the second quarter of the year, the bank and the rate setting committee might have slightly more reason to be cautious, which it already was with its voting record in the most recent decision with regards to a reduction in the base rate. But we see here now what this is leading to, and again, getting back to that overconfidence piece, the lines, and those represent UK margins and export margins respectively. And we see in that green box bar, which is the future expectation for where the sector expects those aggregate figures for price setting behavior, both for UK's and exports concerned to come in. The lines representing margins are expected to grow into positivity for the first time in a while. Now that's something that has been over expected for the past year, where the sector consecutively for the past 2 quarters have expected margins to move into positivity again in aggregate, but they haven't quite done so. And this is reflected as well when we look at that sort of ONS net rate of return data, where we see actually ever since the pandemic, and I know we're bored of using that word, we saw the services sector on aggregate on average make a net rate of return of around 15% in the UK, and the manufacturing sector was there as well, at around the 13 to 15%, give or take. Ever since then, there's really been a shift change where now everyone took a significant hit, both the services and the production sector. But now the services sector is back up to it around, give or take, hovering around the 15% mark. But now the new normal, the new floor, really for the manufacturing production industry is at around the 8-9%. And so it's sort of in keeping with this margins data that's not quite coming back up as margins continue to be squeezed, or there isn't enough breathing room in the sector, particularly with space, with the ability to raise prices in order to see those margins come back. Because of course, as price setting behavior cools, as it comes down, the space on aggregate for the sector to recover those margins also shrinks in kind. Next slide, please. So now we're looking at confidence. And so this is what I suppose is the soothing pat on the back with some of this data that's a bit negative in the short term. And it certainly calms tempers around generating any serious worry on this quarterly short-term data with regards to output getting just negative. So you can see in the past, really almost for 2 years now, that confidence line, looking at the far right of the graph, has been rather consistent. And now this is a diffusion index, which is a sort of fancy word for above 5 meaning positivity, below 5 meaning negativity. But you can see the red line representing business confidence. So that is confidence on aggregate within the sector's own business. And the orange line represents the confidence within the wider UK economy. And so both are performing quite well and growing all the while. And particularly interesting in that Q2 to Q3. So just the very final tail of the chart there. And we see actually, despite I just detailed to you the outputs gone turn negative, orders haven't come in what they expected. We've seen from that expectation comparison graph that actually the sector's data has come in far beneath what they had expected in the second quarter. All the while, confidence continues to not necessarily explode, but remains robust and growing. So that certainly adds some soothing factor to anyone that would, perhaps myself, that would look at this short-term data and get a little anxious about where the sector might be going in the next quarter. Let's go to the next slide, please. So this is the final metric slide. So we're looking at employment and investment intentions. I think, I'll summarize this at the end. I think this is really important, the employment data, when we're looking at the whole picture about what's going on in the short term with regards to output orders, so on. When we see this, as we've seen before at about 23 Q3, in the short term, when we see what's tantamount to a hiring freeze, on aggregate, and we see there look on the far right, just to the left of the green box bar, you can see you probably can barely see the orange slither that's just the negativity, that aggregate balance figure for employment. But that is effectively surmises a hiring freeze in the industry. But of course, the question might be, how can that be at the same time where vacancies are high? What this means in the short term is it often means a sudden focus on liquidity on the wage bill, a degree of nervousness in the short term in the sector about not going too long on capital. With regards to investment intentions, you can see that orange line, and why that doesn't go into the future is that the investment intentions metric runs on a rolling 12-month future expectation. And you can see it's pretty much, despite arguably down a tiddly bit compared to last quarter, it is at roughly the same level that it has been for 2 years. So we know capital expenditure plans are in somewhat of a holding pattern, particularly over the past 2 years, a combination of the political uncertainty, which is now, of course, more certain, but around the fundamental cost of capital as signaled by the base rate. Now, of course, while this data was collected sort of between or amongst the base rate decision, it will take some time for that effect to filter through into capex spending. However, the signal might be enough that I think the strong expectation is that sure, it was only a reduction by 0.25%, 25 basis points for the Bank of England's base rates come down. The expectation is that now this is the start of the end. And so it'll continue to creep down probably over the course of a year and a half, 2 years, continue to creep down. But that will be the signal many manufacturers will be taking, that right, now's the time. We've held on for 2 years onto this capex while the cost of capital has been expensive, the uncertainty has been there, and we know some of it's pent up, and a certain degree is pent up, even indeed as evidenced by this chart, that line remaining sort of robustly positive, probably a bit generous, but positive and steady for the past year. So we'd expect to see some of that rendered. Particularly, perhaps it won't move the needle by next quarter, but certainly we'd hope to see that by the first quarter of 2025. Quick note here on the green box bar. Now, that is the future expectation for employment, but unlike the other metrics, it would be unfair to interpret this as the sector thinks the employment balance figure is going to come in there. What that represents really is the demand for labor, as evidenced by vacancy rates. And I always mention this as a running metric. So there's, as of the latest data for August, there's 61,000 live vacancies in the UK's manufacturing sector, which is equivalent to 2.5 roles vacant in the sector per every 100 employed. Now, that long-term average for that vacancy ratio, that vacancy rate, is 1.8. So it had been in July of about 2022, it peaked at around 4 jobs vacant. The demand for labor was twice as feverish, or the shortage was twice as significant, however you want to phrase it. It's come down since then. We're moving back down to that normal long-run 30-year average of the floor for the vacancy rate in the UK's manufacturing sector of 1.8, but we're still above it at 2.5. So there's still a sort of an above normal level of demand if we're using the vacancy rate to measure it for UK manufacturing skills and labour. The next slide, please. And then this is just a visualization of those forecasts that I mentioned. So just in revision, 2024, we've revised downwards from 1.2 to 0.5. You might say, gosh, what a significant revision, but we're still down amongst the reads here, 0.5, 0.81. These aren't very significant numbers. I have the next slide, please. And this is the exact same as the first slide. And I think, I've covered a lot here. And I think just to make a short takeaway, I want to say we've seen short term, we haven't met our expectations in terms of what we had expected as pundits with regards to output and orders. We've been quite confident about that. The sector seems unfussed, particularly with regards to how the overall confidence metric hasn't been fettered by it. But particularly with regards to employment and investment, we'd expect that to start to come through in Q5. So on balance, despite the figures being a bit diminutive, I'd say we're more confident than not that this is a short-term flash for Q3, and we'd expect to see slow but steady growth continue to resume back into the sector by Q4, and certainly if not, then by Q5, which will lead us to hopefully ultimately put more upside into 2025's manufacturing forecast. Thank you very much. I'll hand you back to Richard now.
Thank you, James. Yeah, it's a bit of a curate's egg, isn't it? It's kind of there's some really positive future messages coming out of that, but they're not quite tied in with kind of what we're seeing in terms of output and order book at the same time in margin. So it feels like it's a bit of potentially an inflection point. So the question is this an inflection point, or is this a blip? And I guess we'll have to wait on that. So thanks very much, James. If you have any questions for James, please do add them to the Q&A, and we'll pick those up at the end. I think there's some functionality at the bottom of the screen for that. Without further ado, welcome, Stephen Phipson. Always lovely to have you join us on one of these sessions, Stephen, especially as there's so much going on around manufacturing at the moment, right? So superb to have you. Just for those who haven't joined one of our sessions with Stephen previously, Stephen's the chief exec of Make UK. He's held that position since 2017, but he cut his teeth a long time ago as an apprentice at Plessey, and then since then has moved on to more stellar roles in his last 35 years working in manufacturing, everything from working with in the security industry with people like Smiths Group, through to taking on quite senior roles, and very senior roles actually within the civil service as well, around defence and security organisations, so organisations such as the Home Office and the Department for International Trade, so supporting our exports around the globe as well on behalf of UK PLC. So Stephen, thank you very much for joining us.
Great speaking.
Just as I was saying, there's a lot going on at the moment, right? And I think, as you sort of alluded to before we started the call, you are getting pulled from pillar to post to provide opinions on all kinds of things, which is fantastic for the industry as a whole. I mean, if you look at it, clearly we've got a new government. Your conversations with the Labour Party prior to them winning the election, go quite a way back as well in terms of developing relationships, putting across the message for manufacturers, both within the UK, but also their role in a broader global manufacturing perspective. On top of that, we've got a budget coming up on the 30th of October. It'd be interesting to see what comes out of that, and any insights you might have or might be pushing towards, let's put it that way, in terms of what might come out of that. Again, we're coming up to conference season as well, so there's usually a whole bunch of things that people like to make statements about during that conference process, make some big announcements, some splashy stuff as well, so that would be really helpful. And then there's the broader, conversation that obviously we've been having since the dawn of time around a proper industrial strategy and allowing manufacturers to have a template and a roadmap to work on, to allow them to think about that employment question, the investment question, automation, all kinds of other stuff, and what sort of government backing might sit behind those words as well. And I think that's the one bit that when I talk to manufacturers, they're kind of saying, okay, words are great, lovely. Question is, what's going to sit behind that? Has the proper thinking been done? And is it really clear what we're going to do and really clear what we're not going to do as well? So it'd be great to get your views across the board, Stephen. I mean, if we start on just new government and what's coming across your desk at the moment, that might be quite a useful place to kick off to give people a feel for it.
Yeah, sure. Thank you, Richard. And great as ever to sort of recap where we've got to. So since we had the change in government, it's been non-stop. You cannot fault their enthusiasm, let's put it that way. And, it's a very different sort of conversation. I've met now with the Chancellor twice, with Johnny Reynolds several times, with the Secretary of State for Education, the Deputy Prime Minister, Angela Rayner, and we'll come back to that probably because that's an immediate point that we're looking at. And I think, we're talking the language of manufacturing now, which we weren't before with the previous government. You've seen Johnny Reynolds come out talking about the work we did together on industrial strategy. And part of the confidence that James was talking about when I talked to manufacturers in the last couple of months has been around all the announcements that we are going to finally have an industrial strategy, because it's absolutely sorely needed. We need to tie together, the different aspects of government, so the skills agenda and the taxation agenda, the incentive agenda around manufacturing. And we need to really work on what is the biggest opportunity for manufacturing in this country, and that is the transition to net zero, and really a plan for how all this is going to be hanging together. Where's the hydrogen strategy? Where's the carbon capture strategy? And in the early discussions, this is all intended to be part of the new industrial strategy. There is now in DBT an industrial strategy unit set up. We're working very closely with them. We're waiting any day for the chairman of the new Industrial Strategy Council to be announced by government, and that for that agency to be set up on a statutory basis, which is something we've never had before in this country, which will give us much further, we're talking about 10-year cycles now, not parliamentary cycles, which you need if you're looking at 7 to 20-year investment cycles in manufacturing. So that's given a lot of people a lot of hope and built a lot of confidence, because if we look into those numbers in a bit more detail, one of the points is around investments. I mean, we're still relatively low, although the manufacturing sector is one of the punches way above its weight in terms of the ratios of investment. I think for 9% of GVA, we're investing 14% of business investment goes into manufacturing, so above its weight, but still not, there's a lot more waiting to see what that looks like. And we've got two events that are going to trigger that. We've got the 14th of October, where we've got the Investment Summit, and that's going to be held in London. This is the Labour Party's first investments, curiously timed 2 weeks before the budget. I would have thought we should have done it after the budget, but that's a whole other thing, right? I've made that point to Rachel Rees. Seems to be the wrong way around. But anyway, they want to set out their stall there. And we are going to have a focus there on manufacturing, which is really important. First time we've really done that, rather than all the other new sectors. But this is a sector that's there.
Yeah.
And so there's the right mood music. I mean, I suppose on balance, I would say we've got lots of good announcements and lots of blank sheets of paper with detail at the moment. And that's the job, is to fill in those blanks as to where we are. I think the other interesting thing from my perspective, Richard, is the language of the large manufacturers, the large corporates. I mean, if you remember, the structure of manufacturing in this country is roughly around 800 large manufacturing companies and 200,000 SMEs. That's the sort of way that we see the sector at the moment. And if you talk to some of those big names that we all know and love, and chief execs, a lot of them are very interested in my discussions with government. So I've had a lot of discussions with them. We're starting to hear a new language coming through, and it's the language of localization. So a lot of KPIs now on these larger manufacturers are thinking about geopolitical risk. It's now become a board issue. I think sustainability and thinking about, resilience and sustainability is all about risk, really, for the large manufacturers. And where are you on that line between resilience and sustainability? A lot of people thinking about that, and a lot of people starting to measure what their localization rate is in the UK compared to investments they've got in Germany, France, Spain, etc., and starting to examine why it is that we haven't got the supply chain investing at the same rate in certain countries. So it's been really interesting to have that. I mean, I was talking to, again, we probably won't want to mention individual names, but, in the automotive sector, it's not unusual to have 26% localization rate in the UK compared to 70% in Spanish and French and German.
It's stark, isn't it?
It's very interesting.
Yeah.
And in the transition, don't forget, if you look at automotive, we're quite heavily dependent in the supply chain on internal combustion engines. And a lot of them over the next 2 or 3 years will transition to EV platforms. And what's that look like in terms of investment for that supply chain? And that's on everyone's minds at the moment. Localization rate. It was interesting. I was speaking to everyone from automotive through to a big commercial airline engine manufacturer the other day, and they're all talking about localization metrics. That wasn't there a year ago. So part of this is, how does the industrial strategy encourage that incentivization of investment in the supply, much more focus on the supply chain now than there was before. Yep. So we've sort of moved from, if you remember, we've gone from friendshoring and nearshoring to onshoring to now localization rates is what we're talking about now as a mechanism to reduce risk in those larger manufacturers and thinking about where they invest depending on that localization rate. So that's really an interesting change we've seen in the language, and I think an opportunity as long as we get the industrial strategy right. And most importantly, I mean, whenever we look at the transition to net zero, and bear in mind, we've got less than 10,000 days to go now to our legal requirement for net zero in this country, you are transitioning hundreds of thousands of jobs to new types of working, new types of technology. We've got a number of, legally binding metrics coming into play. So by 2030, 15% energy reduction in the industrial sector compared to 2019 is a legal requirement. No more internal combustion engine production past 2030, even though you could still buy one. But that was another strange decision by the previous government. But we might see that brought back into alignment. And also, you've seen from James's data that export orders are up, primarily to the EU, if you look at it.
Yep.
And we're about to experience a load more things coming on from the EU now. So on mid-December, the new general product safety requirements come in, which is a whole other raft of reporting for manufactured goods out of this country into the EU. Again, we're not communicating that very effectively. I've been talking to government about whether we can have a forward look so we can communicate what that timetable looks like for some of these new European requirements coming through, as it still remains our biggest export market by a long way, for example. So we've got some of those sorts of things to be concerned about, and we can talk about some of the other big challenges perhaps a bit later. But the opportunity is there now for the government to really have a comprehensive and robust industrial strategy. And I think that's building confidence. Can we turn that into real investments as opposed to intentions is going to be down to, I think, how people feel about what those announcements look like up to the budget and whether we're going to really make progress on this industrial strategy.
Yeah, it is interesting. The next 6 weeks is going to be really interesting, I think, because it needs to be coordinated and messaged in the right way. It's not just the point of, I think there have been a few false dawns, I suppose, let's call it that, over the last few years of people talking about it but not really doing anything about it. That's the question, right?
That's right. The previous government just lost the plot completely with this, and it's just, let's go back to free market economics in a world where that doesn't exist in other countries. So, everyone's doing protectionism and also Inflation Reduction Act and all sorts of other things. So we must operate differently, and so we need. But this issue about the transition is such a big change for manufacturing, digitization and transition to net zero, that you've got to tie together the skills agenda, the investment incentives. I mean, at the moment, if you're a manufacturer and you invest in green technologies, your business rates go up. It's a disincentive. I mean, we've got to get these things sorted out, so it's a proper plan is what we've got to do.
Yeah. Actually, on your point on localization, etc. If we just touch on automotive, and we'll sort of pull back out from it again, but you see statements in the press, Volvo changing their production between EVs and internal combustion because they're saying the network really isn't there and the demand isn't there right now to actually push that through. There's potentially a disconnect between the intent of government and the market, and trying to find a middle ground between those two is going to be like sort of threading a needle, I suspect.
It is.
And the other side of it is, in terms of battery technology, etc. Obviously, we've had a false dawn on that one as well, Stephen, in the past. And it's usually been, compared to what's happening on the continent, it's kind of absolutely minuscule compared to sort of European investment. But it does raise the question of, have we missed the boat on that? If that localization and batteries, whatever percent of a car will be going forwards, it does raise the question of, are we kind of fighting a battle that we can't potentially win on some of this stuff?
Well, we are, if you look at it through the lens of EV. I mean, on EV production, battery, you're right. I mean, we've got the one startup effectively in Somerset, which everyone's working like crazy to get scaled up quickly. But we're probably 10 years behind very largely. If we look at the technology that's coming out of China, I mean, we have actually been through some of those Chinese products. And about half the half the exports of Chinese EVs are owned by European and American corporations. So the recent idea about putting tariffs on that is actually met with derision by those companies. This is the government interfering in corporate sort of globalization. However, they are some of those new products from China are, we saw a vehicle the other day by BYD. It had a 600-mile range. It felt and drove like a BMW, and it cost 12,000 euros. I mean, they are way ahead in terms of what they're able to do. So what we're seeing in other countries now is multiple strategies, and it may be a chance where we have to rethink this. Germany, for example, has 3 strategies for cars, for automotive. EVs are one of them, But hydrogen's another one, and they've just legislated that every 100 kilometers there's a hydrogen filling station in Germany. BMW announced 2 weeks ago that the next generation of vehicles for them are hydrogen vehicles. So hydrogen's another option, and biofuels are another one. So in Germany, you've got a three-pronged strategy because they like us can't build enough capacity in the network to be able to allow everybody to plug in an EV. And at the moment, we've got a binary strategy here, or if you call it a strategy, it's not much of a strategy, but legal requirements that there is no more internal combustion engine production past 2030 for the manufacturers means at the moment in the UK, we've largely gone towards EVs. You're right, penetration 7%. The big challenge is the infrastructure. National Grid's got to double the size of the capacity. Then we've got all the constraints around the supply chain of that. So in the industrial strategy, this is one of the subjects that we've been talking about, is about how we hang that all together. Yeah. And we have a great chance to leapfrog some of these technologies. I mean,
Totally.
we have great advances in burning hydrogen fuels and some of the new sustainable fuels. I mean, so I think we'll see that being changed.
We're big fans of hydrogen here at BDO. Actually, we did a review a while back of the technologies and what actually makes sense from a practical perspective, and hydrogen comes out way above, and just in terms of sustainability as well. I mean, you're not digging loads of stuff out.
Well, BMW UK's got 2 hydrogen-powered X5s in the UK. And they are incredible, I can tell you, absolutely incredible vehicles. I mean, there's only 5 filling stations as well in the UK, but one of them's at Heathrow, so at least they can fill it up at Heathrow, which is quite interesting. But what a great vehicle with hydrogen power in it. It's very interesting.
Exactly. Right, well, I'm going to pull back out of that because that's all fascinating. We could spend the whole time
we could
talking about EVs. Just going back to sort of budget and Rachel Reeves, etc. In terms of mood music that you're hearing from a manufacturing perspective, it'd be great to get your views on that, because I'm sure it's on everyone's.
Right. So I mean, Rachel, we've had great meetings with the Chancellor and her team in the Treasury. It's very interesting, and they've been listening. I haven't got much back from the Chancellor. She isn't telling me exactly what they are going to do. And as usual with these things, it's the last few days before things are finalised, and there'll be another couple of meetings in between for us. But the industrial strategy, I think we're going to see the announcements of progress on that from the Chancellor, and why that's important in the budget. That's going to be important. We obviously want to see the continuation of full expensing, because that's just starting to bite. I mean, it takes a while. I mean, manufacturers are very, very keen on that. Interestingly, Richard, it's something for BDO, is that the Treasury has set up a team, a task force inside Treasury, looking at the available finance for manufacturers. There's quite a lot of reports about people starting to struggle to get financing for some of the capital projects from the banks. And so the Treasury is now taking that seriously and taking a look at that, because obviously investment is absolutely a top priority in terms of where they see that. And the other big issue we've been dealing with is skills. I mean, if it's not talking about industrial strategy with companies or localization, which is the current sort of fashionable thing to talk about, then it's going to be skills. And James alluded to some of that challenge, and how we address some things like the apprentice levy system. And we've given the Chancellor some very, very short-term specific things which don't cost very much money for her, but actually makes a very big difference to our ability to reverse the trend of a 42% decline in apprentice starts in this country since the levy was introduced in 2016. So she's got all of that detail to think about putting into her budget. So obviously on the other side, we're hearing all the negative expectation management at the moment about all the taxation and everything else. I'm not sure we're going to see much movement on business rates. Although I've made the point about the disincentives that creates around the transition, for example, which we need to address at some point. But there's not much detail coming out of Labour about business rates reform. And I know Treasury find that a very difficult subject to deal with anyway. But it's going to be around jobs. We're also talking about slightly different language now. I think a very good point was made to me by Treasury officials, that the language now is not so much about currency, but more about careers. So really about jobs focus and about quality of jobs, which probably moves us on to the other big points, which is sort of related, which is the Deputy Prime Minister's big push on make work pay. And we could probably spend a few minutes talking about that, Richard, actually, about the change of employment terms. You'd have seen all the proposals they're making. Well, tomorrow we do have a meeting with 11 trade unions and the business groups and the Deputy Prime Minister to finalise the first part of Make Work Pay, which is around 0 hours contracts and what we're doing around that. I mean, in terms of manufacturing, pretty much because we've got a skill shortage, the conditions are pretty good. Lots of these terms and conditions are quite good. I think the worry is if you change everything at the same time in employment law, what are the unintended consequences of doing that?
Yeah.
And flexibility and seasonality in manufacturing. If you're a food and drink manufacturer, you may double your workforce in the period up to Christmas, for example. And is it flexible enough to allow that to happen is on people's minds at the moment. So we are right in the middle of that debate, and tomorrow is, I think, because they want to announce things at their conference, it's kind of like, this is going to be the last chance to make sure that they understand where we're coming from on Make Work Pay. But this is going to be the largest change in employment law in this country for the last 100 years. So it's a very significant change for everyone, and we need to make sure it's a positive one. I think it's going to affect areas like hospitality a lot more than it's going to affect manufacturing.
Yeah.
So we'll be able to see exactly where they're coming from tomorrow.
Yeah, and I think your point on apprenticeships, it does feel like the mood swing is quite significant, especially, even in the press today, there's the top universities coming out saying that, the cost of educating people at universities, they're losing money on every single UK student and all the rest of it. And
I mean, the point
that swing towards actually, playing towards employability and apprenticeships is definitely one that seems to be part of the zeitgeist, if I can use that.
No, it does. And the specific thing I want the Chancellor to address, and I'll just explain it, is that if you look at apprenticeships in manufacturing, the base level is called a level 3 technician level apprenticeship. It's 90% of where we start people off in manufacturing. And when they set the rates in 2016, the amount a provider gets is £27,000 for each 4-year apprenticeship. And today it's still £27,000 for each apprenticeship. And if you're an FE college, it now costs £35,000 to deliver it because of what's happened between 2016 and now, and all the inflation and costs, etc. Which means that what's happening, that 800 large company cohort is investing like crazy in their own training academies. So BAE Systems and Rolls-Royce are brilliant. They've got their own 2,000 person apprentice provision because they can't find people in higher education to deliver it. They're doing it themselves, investing like crazy. But the 200,000 SMEs, the poor SME with 20 guys out in East Anglia, his local college has stopped providing engineering apprenticeships because it's underwater.
Yeah.
And we're seeing that everywhere. We're seeing private training providers exiting the market because you can't, where's the money going to come from? 27,000 versus 36,000. And that's the major driver why we've seen a 42% drop. So we've got all these little companies want to take on an apprentice, have got nowhere to send them.
Yeah.
And the large companies with their own training academies sort of get, playing their own field there, doing it very well. So I get the pushback immediately from the Chancellor is always, well, if there's a problem with the funding, why doesn't employers put their hand in their pocket and fund it? But the big companies are doing that. It's the small company that hasn't got a local FE provision because it's underwater. So let's fix that. They underspent 800 million in the levy funds last year. This would cost them about 100 million to fix this problem immediately and get the FE colleges back up on level 3 technicians again. And so, these sorts of fixes practically is what we want to see, Richard, really.
Yeah, I mean, it does underline the fact that an industrial strategy covers a multitude of areas. It's not just
it does
plaster. Yeah. It has tentacles into all kinds of other areas of government, and making sure that's coordinated.
Yeah, exactly.
And fits together. And like you say, that unintended consequences piece is minimized as much as possible. You'll never get rid of all of it. There will be something in there that doesn't quite stack up, and people will probably shout about it. But the fact that the intent is there is very heartening. We just need to make sure that there are people.
It turns to reality.
Yeah, exactly. That actually translates into something real.
And I do think, I mean, back to James's presentation, that's one of the main drivers behind that confidence level remaining high, Richard. That now the language is talking about an industrial strategy properly, whereas we've had the last couple of years of everyone's cancelling industrial strategies that we had before. But now we're properly thinking about it. I think they're waiting to see. I think the budget will be a big event, the investment summit, those things. The announcement of the ISC will be important. But if they take the right steps as government and we don't delay everything, I mean, I was talking to Skills England, the new body they've set up around apprenticeship provision, and sort of the answer you get on most questions is, how long is it going to take? It's going to be, well, 18 months. You know, I think we need to see it quicker than 18 months.
Yeah.
But I think that will persist. I mean, if we carry on and deliver the right sort of messages and signals to industry, they will have the confidence to invest. That's important.
Yeah, exactly. So that's really helpful, Stephen. I think it just underlines the fact that manufacturing is squarely on the government agenda.
Yes. Yeah.
And across a number of different capabilities within government as well, which is extremely good news. If we kind of step back from UK and we look at where we sit sort of globally, clearly there's some other activities, should we call them activities, going on around the globe as well. So other elections taking place sometime in November, I think it is. But obviously that may have an impact on our relative competitiveness globally. I mean, if any thoughts on that in terms of, let's start with Europe to start with. I think you were talking a little bit earlier about some of the legislation that's coming our way that we obviously need to remain compliant with. But opportunities for growth outside of the UK would be good to get your thoughts on that.
Yeah, I mean, export growth is obviously key to what the government is, and that's probably one of the reasons why they're so interested in the manufacturing sector, because it does represent 45% of the exports of the country, even though it's a relatively small proportion of GDP. So really, really important to pay our way with right exports. I think we are very encouraged by the sort of mood music coming out of Keir Starmer trying to rebuild relationships with European countries. I think that's important. I don't think we're going to see major revisions to the trading relationship, the TTA that we've got with the EU. We've had lots of discussions with the new government around that. I think there is a direction of travel which says that we might get some alignment. I mean, as we go through time, we are diverging more and more and more. I mean, we've got some very significant events coming up, I think, which bring this into focus, Richard. CBAM is probably the most important one, where at the moment we're going to be a year out of sync with Europe. And that's existential for the energy intensive users in this country. So chemical industries and steel industries, we can't be in a situation where, you know, non-compliant products from Europe can flood into the UK market as a result of being misaligned on CBAM. And also, likewise, on the other side, we've got to figure out how our manufacturers start to report CBAM requirements. So do we certify products? I mean, and we're only talking about 2026 or so it's not far away. And these are really important to get right. And we have to do a lot of that ourselves. You know, it's really important that we align ourselves properly to Europe. And I think with Keir Starmer, the previous government, anything with EU on it was like thrown out immediately. You know, this time round, it's like, let's get a serious discussion about alignment. The more we can get alignment, even if we're not going back into the EU or customs union or anything like that, the easier it is to take advantage of those export opportunities. And a lot of it is around new technology for us. I mean, we're really good in innovation. Every time I go to Germany or France or the United States over the last year, the one thing they say about the UK, this is where all the ideas are generated. We've invested so heavily in innovation. This is where we have all the new technologies. So where there's great demand, you've just got to make it easy for people to export. And I think the EU is going to remain our largest market for the foreseeable future. And so how do we get that, make that business easier effectively? And I think, you know, we are getting there with the government. And I think the recent thing we saw with the Prime Minister going around Europe is a good sign for that. I think that's important. The US is somewhat different. I mean, I think this localization discussion, when you talk to the corporate guys coming from overseas, looking at where to invest, there is a rise of protectionism generally. I mean, we were at the end of globalization. We never quite reached the ultimate globalization, but we're now back into protectionism again. Barriers are going up. A lot of these new requirements from the EU are effectively trade barriers, non-tariff barriers going into place. So the idea that it's all a free market just doesn't work anymore. And in the industrial strategy, that's got to work out our place in the world and how we're going to deal with it. But I think the most important thing is to remember innovation's key. We did some very interesting work with Innovate UK recently, where we were trying to help with scale up. I mean, our challenge in this country is we don't scale it up. We're great at generating it, but we are hopeless at scaling up these new technologies. And we were trying to do matchmaking. So we had 5 of our major manufacturing businesses here in Broadway House and 130 brand new startups from Innovate UK. And we did a matchmaking exercise of the likely technologies fitting automotive or aerospace or whatever it was. And it was brilliantly successful. And it's sort of making that a reality is important. People just don't know what we are good at, and where, you know, joining the dots is important. That's
Yeah,
all part.
it's quite scary to think of you as Cilla Black on Blind Date, Stephen. It's like...
Yeah, we're trying our hardest.
But just on that, interestingly, just as BDO, we're joined up, and we're very much an ingrained member of what the Scale Up Institute, which is exactly
yeah. In fact, Irene Graham was
yeah.
with us on this one. She was with us on this event.
Okay, great, because that's, you know, and it kind of recognizes the fact that, you know, the vast majority of businesses are in that scale up situation, and that you don't have to be a small business to be in scale up mode either. It's
no, you don't.
Question of you know, ensuring you've got the right access to the right things, whether it be funding, advice, or whatever else, to actually do that effectively and efficiently as well. But it does underline the fact that, you know, as a hub of innovation and ideas, the UK is absolutely top of the heap. But
we did a roundtable in America with big business there, and they said to us, we look at the UK with envy. You generate all the ideas. Everything comes from the UK. We're just very good at commercializing it. We've got all the money in the United States, and we grab your ideas and we make them into a reality.
Yeah, we're really good at solving problems, usually with constraints around them as well. And that's what makes them incredibly good, is because it's almost the fact that sometimes you have to struggle through it probably leads to a better product in the end, actually, because it sort of recognizes some of the practicalities of it. So, Stephen, thank you so much for this. Always good to talk to you.
Very good.
Very much appreciate it. I think we've got a couple of minutes for some Q&A as well, whether it's for me or Stephen or James. Please do pop it in the Q&A section. I think, Bal, can you, if you can sort of coordinate that, that would be great.
Yeah, no, absolutely. I think based on the conversations you were just having, Stephen, just a question to you first that we've just literally had come through. How is the new government viewing R&D tax credits, grants and other support for the industry?
Well, we know they're in the middle of rethinking it right now, Bal, because you remember we have a grant system going on with Innovate UK. And at the moment, they've sort of stopped giving out grants. I think Treasury's looked at that and are thinking about rejigging the R&D tax credit system instead of doing grant funding, which is quite interesting. So that would indicate quite a large extension of what they're talking about for R&D tax credits. However, we have not seen the detail. We have another meeting in the diary with Treasury for next week, and I think we might get more detail there of what they're thinking. But certainly it's on the agenda, which hopefully is good news. So we'll see when we get through it. But I know that they're thinking about it for the budget this time.
Brilliant. Thank you, Stephen. And James, just coming to you, we did have a question around the figures that you shared. It was just asking whether the figures show inflation adjusted.
Yeah, so our forecasts and other macroeconomic indicators, they are inflation adjusted. The balance figures, because they work in a slightly different sense, they are in essence inflation adjusted, but they're predominantly seasonally adjusted, which in effect is a flavor of inflation adjustment. So the short answer to that question is yes.
Okay. And another question to you, James, because you covered this within your presentation. What are you forecasting to be the hiring trends in this sector over the next coming months?
Yeah, so I alluded to, it's our current view, despite the employment metric falling flat in our data, because there is, as I mentioned, there is that a super normal, above normal level still of vacancies in the sector. Presuming with the presumption that this does, and I think there's more evidence for that to be the case than not, that this is a short-term slowdown and just pretty much limited to the quarter or next quarter. I do expect, and it's certainly our view, that employment will continue to grow. The sector may remain nervous into next quarter with regards to its wage bill and overextending itself in liquidity, but certainly into Q1 of next year, we expect employment to continue growing, perhaps only just through the virtue that vacancy rate remains above that long year 30-year average for where it tends to sit at. So I'd expect expansion in employment levels beyond the usual, particularly if we look over the average of the next 6 months, presuming there isn't any significant disruption to the sector.
Yeah. Okay, thank you, James. Another question that's come through. How does the UK manufacturing outlook compare to that of other European countries? James, we start with you on that. They've made a point around Germany's automotive industry is seeing a slowdown and job losses. Is that a similar scale to the UK?
Yeah, so of course our work you know leverages our membership and we look at the UK, but we do look abroad, particularly using Standard & Poor's PMI. And interestingly, with that actually the Eurozone PMI has been in sort of contractionary territory for quite some time. I mean, really since the start of 2022. And it's shrunk well below its 50 line, which is effectively similar to our balance figure of 0 for some time. The UK was there as well under their metric until about pretty much the turn of the year, where it's returned to positivity. So when we're comparing those things, and that's a sort of apples to apples comparison, Eurozone manufacturing is catching a little bit of a sharper shake of things in terms of the negativity than we are, and it's effectively that inflection point is the start of 2024 that we were both in contraction, our sectors both on aggregate in the Eurozone and us in the UK, and then since 2024 we've been having a bit of a better run at those concerns of output, orders, investment, and those other key concerns than our partners and competitors across the channel.
Thanks, Bob. Just to add to James's point, I was talking to a European manufacturer only, was it yesterday actually? And they were saying, yeah, there's been a distinct slowdown in their European manufacturing demand. Most of their stuff goes into the automotive sector. And I think the sort of the level of order books for new cars has dropped quite considerably, which has kind of led to them basically having a flat order book. So their growth has been very much put on hold. The expectation from them was that things would start picking up, but they're seeing demand for their Asian manufacturing base actually booming at the moment, just purely because of the size of the Chinese market is driving a huge amount of demand for what they produce out of Asia. So they're seeing Asia as their big growth area. Europe's kind of flat, pretty much aligned with what we're seeing in the UK at the moment. But I think once things start to develop a little bit more in terms of European strategy, then it should start picking up again. Stephen.
The other thing to bear in mind is the structure of our advanced manufacturing sector.
Yeah, exactly.
It's slightly different to most other European countries. I mean, yes, we do have a strong automotive sector, but we also have a very strong electronics sector. So semiconductor test equipment exports are at a record high, for example, which goes to China, to the semifabs from the UK. If we look at our commercial aerospace business now, we're the second largest commercial aerospace component manufacturing country in the world, and that's doing very well. So if we look at where we are there, and other things like space, for example, I mean, these are sectors that some of the other countries aren't so strong in. So we've got a good spread of advanced technologies, which gives us some resilience when we talk about downturns and difficult periods, I think.
Yeah, absolutely. I totally second that. Absolutely right.